Today I'm going to show you a simple strategy on the 5-minute charts with no indicators. Let's get into this right now. What's going on, everybody? Today we're looking at Euro USD on the 5-minute chart, and we're talking about the secret strategy for scalping when you're trading the market. Well, it sure seems like a secret, but I think sometimes people complicate trading by loading the chart up with too many indicators, bouncing from strategy to strategy. But on this channel, we're all about simplifying trading. We try to keep the chart bare as possible. And by doing this, we're able to cut the strings and free us from the belief that trading can't be done. And that's what I intend to do for you today. Now, when you're looking at this, we already know we mark things off where we expect price to change direction. We often do this on a higher time frame, and we look for an entry pattern on a lower time frame. Now with this one, we're looking at the 5-minute. We're also going to look at a higher time frame, or talk about a higher time frame, but we'll get to that. Now on the Euro USD 5-minute here, you can see how we have areas marked off. And what I want you to pay attention to is how price left, but came back into the area to test this area. And what's giving me a clue that it may change direction is that the body of the candle never closed into these bodies. And when you see something like that, that could be a possible entry. So at that point, your stop loss, this will allow you to have a tight stop loss, and then you just would have been targeting the next high. And you know I aim for the body high of it. So you can see here the risk to reward was 7.58. Now this isn't going to always work out for you like this. But as you start practicing this, you're going to notice this more and more. And as we go through the chart here, you can see the same thing over and over again. So price left, immediately came back into the area, testing the area. And at that point, that could have been a possible entry. And you would have been targeting a low or a 1 to 2. This is something you're going to have to decide. Again, you can see right here, we're just taking the wicks. Now, if the wicks are too long, then you have to decide, you have to make some adjustment. But in this case, we're taking all of the wick, running it across, and you can see how price broke through structure, coming back to retest it, wicked right into it, and the body of the candle closed below, not above, into the other body. So at that point, that could have been considered an entry pattern. And now you got to decide where you want to target. So there's a couple different places you could pick. You could see that you could go above the body here, or you could take a tighter entry just above the wick and target the low. And in this case, the risk to reward was 8.72. And this happens over and over again. Now, there's also going to be lots of failed attempts on this, but you keep practicing, fail forward, because everything you want is on the other side of this. So the more you practice, the better you're going to get at this. And there's something that you can do when you're trying to do well on this. Now, we talk about managing trades where you move your stop loss to break even and you take partials. Now, if you're not familiar with taking partials, that's where you close part of your trade in MetaTrader and try to preserve some of the capital. So if price does come back and hit your stop loss, that you still may be profitable and not suffer the full loss. And if you want to know more about that, I'll throw a video up now, and that will explain how to do that on MetaTrader 4 or 5. Now, when we're looking at this, you can see again how price is left. We have our area marked off. We've marked the wick here. We didn't take the whole thing because that's too big of an area. You're refining it. Price came right back into it, wicked into it, closed above. It didn't decide to close. It didn't close in here. It didn't close within the body of the candle. So at that point, that could have been considered an entry pattern. And at that there, what you would do is stop loss just below, and you would have targeted the high there, or you could have been aiming for more. You could be managing the trade and trying to follow it up as much as you can. It's up to for you to decide. But you can see these are 5-minute candles, and this trade played out rather quickly. 2.55 for risk to reward. Again, you could see how price broke down. We've marked our area off where we expect price to retest, comes into the area, doesn't close within the bodies of the candle. So this is telling me that it may change direction. Oftentimes when you see the body of the candle close into the previous structure's body, that may be a clue that it may be deciding to change direction and may eventually push through that area. Now, that's not an absolute, but that's just something I look at. You can see again here, we have an area here. We've marked it off that was broken through, came back and retested it. And you could have gotten in on the trade. You may not have won this trade. It depends when you would have gotten in on it. There was multiple attempts. And if we run this across, you can see again how price broke through structure here. We run it across. Price came into it. The body of the candle never closed within the previous structure. And it changed direction at that point. You could have had your stop loss just above, targeting the low, or you could have been going much further than that. It's up to you. Now, when we're looking at this, how can we make this better? So when we're marking this off, so imagine on your chart, you've got your supply and your demand. And what you're doing to help improve your odds, you're still looking at entry points on the 5-minute, but to give yourself a better chance of succeeding at this is you're marking supply and demand on a higher time frame. Now you have to decide what that's going to be. Could be the 15-minute, could be the 30, 1 hour, 4 hour, whatever you decide. But imagine you have these two on your chart. You've got your area marked off, and when you're deciding what to do next, imagine price is going through and you're taking entries. You may have targeted all different spots here, but what you should be careful of is when you get to a point where you shouldn't take an entry, is when you're near a supplier demand zone, depending on the direction that it's going. So if price comes to an area and you're trying to target a new high, this might not be the best spot for you, but you can clearly see that if you were targeting an area here, this might be a little easier. Wherever it ends up being on the chart, you don't want to take a trade in the direction of supply or demand on a higher time frame. If it's too close to it and you're trading into it, that trade might work against you. Try to put the odds in your favor. You're just trying to improve your chances of succeeding. So if you were in this area, do not take a buy position if you're running into supply, and don't take a sell if you're running into demand. If you're anywhere in between it, I don't think there's as big of issue with it, but doing simple things like that can help improve your chances. There's a lot more things you can do, and this is just a simplified version of this, but practice this. Use TradingView if you can. If you have the basic plan, you can use the bar replay feature, and that's a valuable tool. And if you have any questions about this, leave me a comment. And remember, the best time to learn trading was yesterday, and the second best time is now. So until next time, bye for now.